You know what's scaring me right now? With a rising rate environment and the Canadian real estate market on the fritz is home equity lines of credit, aka HELOCs. Now, if you're not familiar with what that is, we'll be going through in this video to give you an idea of what I am talking about. We'll also be discussing the trends in Canada and how they will be impacted in a rising rate environment. But if this is your first time here, my name's Nick. Welcome to Ways to Wealth. Before we get into the video, huge favor, huge ask. If you learn something new or you get some value out of the video, hit that like button for me. I definitely appreciate that. And if you haven't already, please consider hitting the subscribe button and turning the notification bell on for similar content just like this. We're going to be starting out by giving you a definition of what a HELOC is. And again, the acronym stands for Home Equity Line of Credit. So how does a home equity line of credit work? It allows the homeowners to borrow against the equity in their homes and simply transferring cash when they need it. So essentially, you're getting a loan based on the value that you've gotten with your home price. Obviously, home prices have shot up over the past 10 years, and people are looking for ways to pull that equity out and be able to have that cash. So it's different than a mortgage because it does have a little bit of a higher interest rate, but that's obviously based on everybody's independent personal finance situation. The borrowing limits that the bank gives can be up to 80%. So this is something that's called a loan to value ratio. So they're only going to give you 80% based on what they value, not only the home, but how much equity that they believe is already in that house. So the interest rates on the HELOCs are usually tied to the prime lending rate, and most banks can be negotiated. Again, depends on your personal financial situation. If the rate is variable, however, the principal will be extra sensitive to interest rate increases. In some cases, a lender will often offer a fixed term, but for the most part, I believe it will be on a variable basis. So a higher interest rate than what you'd be getting with a mortgage. And it's a way for people to use the equity that they built up in their home to either use that money to invest in the stock market, to fix something in their house, or to buy another properties. So that gets us on to the topic of what are the trends right now for HELOCs in Canada. And we come to this article here from Better Dwelling, and we can see this is a past 12-year chart of the history of the HELOC debt. So they take a look at how much HELOC debt is out there in the market, and we can see it's not as high as what it's been before, but we can take a look at what's happened more recently, and it is on the uptrend. We can see in the past couple years, this number has shot up to about $167 billion worth of debt out there in the market, and it's been growing at the fastest rate since 2013. It's made one of its biggest annual jumps in nearly a decade, which is surprising to see, especially since everybody knows that the interest rates are going to be increasing. The Bank of Canada has definitely made that well aware. On June 1st, we did see Tiff Macklem come out with a 50 basis point hike. We also saw the fact that they are not shying away to get to a target rate of 3%. We covered it in last week's video. Mortgage the 5-year fix is trending around 4 to 5%. These are numbers we haven't really seen since 2018. So the market, how will it react to rising interest rates? And that brings us to our next article to discuss what are the impacts of rising rates on HELOCs. So we can see here from Robert Haig, in terms of cash flow, for many people, they won't see that big of a difference. It's just not going to take longer for them to pay back their loan. So essentially what's happening is the money and the interest will go back to paying the interest, but not the principal. So in reality, what you'll see a little bit here is we'll give an indication of what an interest rate increase looks like in comparison to a $100,000 mortgage. So we'll get there in a second, but he does issue concern that borrowers is the cumulative effect of the bank's plan to raise rates several more times. So we're not done yet. They're going to continue to raise rates. And we're going to see a little bit further down here what I talked about. So when they ran the math on what an increase will mean for consumers, for every $100,000 they owe, an increase of 0.5% will translate to $42 a month, or $500 at the end of the year. So you would expect that some people may have HELOCs of $200,000, but you can easily do the math there just by multiplying it by 2. So when you look at that number, $42 a month, and then $500 at the end of the year, is this really going to make a big impact? Well, that's considering right now. We know that the rates are going to continue to increase, but what does that number, where do we get to before we really start seeing an impact? So, when I was looking at this, my honest opinion is that we were going to see a little bit more damage relatively soon. But because the numbers are so small and people may have, fixed HELOCs in there, or the fact that the increase in per month payment may not be that great and they may have that within their budget, we could see continued high prices in housing. At least, we've seen a little bit of a come off from the top right now, but that's obviously the concerns. The supply continues to be a concern. Rising rates continue to be a concern, but I just don't know if we see that capitulation that everybody is hoping for, because of the fact that, realistically on the mortgage side, it may not be that much of an increase. And especially on the HELOC side, which I thought would be a concern at the beginning when I started looking into this, I thought it was going to be much bigger of an impact, but this to me does not seem that big. People have been able to save. Obviously, there's a class of people that have been working from home, haven't been spending on gas, haven't been spending on going out. So all in all, I think this HELOC isn't much of a concern as when I started researching for the video. But, at the end of the day, we don't know how much higher past the 3%. Inflation is still a concern. And obviously, how high can they raise the rates before they really impact the economy? So let me know what you think. Do you think the HELOC, the uprising trend that we've seen to $167 billion in mortgage debt, is going to impact us this year? Or is this something that could affect us in 2023? Let me know your thoughts down below. If you're still here with me, hit that like button. I definitely appreciate your support. I hope you all have a great week in the markets. Happy trading.